So we'll now continue with the fund flow statement in this class. In case of fund flow statement, in your balance sheet, we have all the assets and liabilities categorized into two parts. Okay. Now, current assets, current liabilities, non-current assets as well as non-current investments, and shareholders' funds as well as non-current liabilities. This will be non-fund, this will be fund. Okay, this is fund, this is non-fund. Non-fund. Movement from fund to non-fund and non-fund to fund, or vice versa case, will be called as flow of fund. Will be called as flow of fund. Probably you may purchase the asset. On purchasing the asset, the current asset becomes fixed assets, or sale of fixed assets into cash and it is converted into cash. This will be called as flow. Similarly, you may issue the shares and raise the cash, or repay the loan and buy back the share. Because of that, non-fund also reduces, your fund also reduces. Also flow is there. Even though sometimes you may purchase the non-current assets and you commit to pay later on. So then there's an impact between these two, isn't it? Non-current assets, probably plant and machinery purchased, payable in 3 months later. So the plant and machinery being non-current assets, and instead of payment, current liability is increasing. One form to another form movement is there. Sometimes the non-current is supposed to be payable in a matter of 3 months. Usually, if the non-current liability is supposed to be payable after 12 months. But if it is closer to the maturity period, the non-current becomes current. Or some current liabilities after the negotiation may be converted into non-current. So there is movement. All these things are the good example for conversion of flow of fund to non-fund and non-fund to fund. But if you are purchasing the asset, for that the consideration being in the form of shares. In the form of shares. What happens here? In the form of shares. Then actually what happens? This will not be applicable. This will not be applicable. Because non-current asset also not fund, shares also not fund. If the movement happens within the non-fund, also be considered as not being flow. And debtors may be settled when you are in cashing. Similarly, debtors and creditors mutually cancel. In that case also it is not coming under fund flow. If the things happening, the change happens within this block, also be considered as non-flow, non-fund flow. Okay, probably debtors is converted into cash. Stock sold and converted into cash. Stock also fund and cash is also fund. So ultimate fund will remain the same, so it will not get affected, so it's not fund flow. Similarly, current liabilities is converted into bills payable and vice versa, also be considered as not flow. And when you are converting the preference shares into equity shares, and this will also happens within this block, will not be considered as flow. And here also happens a change within this. A non-current asset is purchased by selling your non-current investments. The change happens within the non-current form. There is no flow. All the flow marked here in blue will called as fund flow. Those things are marked in green is called non-fund flow. You are going to represent that as a statement. That statement is called fund flow statement. See, in your fund flow statement, sources of funds and applications of funds. You can prepare in a T format or vertical format. Write all the sources in the top and write the applications in the bottom. That way also you can write. Now, sources, decrease of non-current asset. Okay, is a source. If it is decreasing, usually you get the cash like, as well as increasing the equity as well as non-current liabilities. Non-current liabilities as well as equity. You may get the cash. In a reverse case, increase of non-current asset and decrease of non-current liabilities and equity will be the applications. Clear? Step 1. Then second one is the difference between current assets minus current liabilities, is called working capital. In the previous year, the working capital requirement being 100. In this year, for the working capital, I am in need of 150 rupees. What does it mean? There is increase in fund for working capital requirement. Then increase is nothing but application of your capital for the working capital purpose. So increase in working capital is application. If the working capital requirement decreases, then it is called source of working capital, source of fund. And apart from that, you have to consider the reserves separately. The change in reserve is nothing but what? Due to the business operations. You need to find out what is the fund you generated because of operating the business. You may get the fund because of operation, that is called funds from operation. Because of operation, you may sometimes lose the fund also, then it is called funds lost in operations. If you finally tally, you'll know from where you get the fund and where the fund is applied. Preparing this is a statement of fund flow statement. Okay. C. Assets, non-current, current. Liabilities and non-current liabilities block 1 and current liabilities block 2. This portion is called fund and this portion is called non-fund. If from fund to non-fund or non-fund to fund, then it is called flow. You can represent that as a fund flow statement. Sale of non-current assets means decrease of the non-current assets. Purchase of non-current assets, increase of the non-current assets applications. And these are non-current liabilities and equities, debentures, shares and borrowings. If these things are increasing, sources. If these things are decreasing, then applications. Apart from that, you are in need of what? Working capital. Compared to the previous year, this year working capital may be increasing. That will be part of application. Compared to the previous year working capital, this year if it is decreasing, then it is called decrease in working capital. Hope you will be now able to understand increase and decrease of working capital. Because of operation of the profit, business, you will be getting fund. I'm not talking about the profit. There is a slight difference between profit and fund. Okay. If I am getting fund because of the operation, then it is source. If I lose the money or fund because of the operation, it's an application. These are the 4 items you have to understand. And of course, dividend and tax paid, you can understand that easily along with the main illustrations. Clear? For calculation of funds from operations or funds lost in operations. Okay, funds lost in operations. From the profit and loss, you have to do some plus or minus. What is it? Your net profit is not fund. Am I right? Your net profit may not be funds from operations. Your net profit due to what? Not only because of funds from operation, you may get due to operation not related to operations also. Like you may have the spare capacity can be let out to somebody else, you generate income. When you have surplus cash may be deposited with the bank to get either dividend or interest, or some profit or loss may be there, but not in the form of cash. Those non-cash and non-operations related items should be removed from the net profit to identify the funds from operations. So add non-cash expenses. This non-cash expenses like depreciation might have reduced the net profits balance. You have to add that non-cash expenses back to get the original value. Not only that, non-operating expenses. These two are going to be added. And what are the two going to be subtracted? Non-cash income, if any, should be subtracted, and non-operating income should also be subtracted. Hope you'll be now able to understand. The ultimate final value in this case being funds from operation or funds for operation or lost in operation. Funds lost in operation. Clear? Hope you'll be now able to understand this case. Now, the non-cash expenses listed here, depreciation or amount transferable to the resource and all, non-cash income related to the reverse of that revaluation profit. Non-operating expenses may be loss on sale of asset, proposed dividend. Dividend is only appropriation, it's not operation expenses. And tax also only appropriations, not the expenses to be debited in the P&L. Whatever the profit you calculate, from that profit you have to appropriate for the government shares. That's why it is called non-operating expenses. Non-operating incomes are profit on sale of assets and dividend received and all. Clear? Hope now you'll be able to understand this part. How to calculate the funds from operation? The funds from operations can be calculated from the net profit by doing some plus or minus with respect to non-operating, non-cash items. Working capital is nothing but the difference between current assets and current liabilities, and compared to the working capital of the previous year, in this year, if you are in need of additional working capital, then it's an application. If it is decreasing, then it's a sources. But anyhow, you don't present directly this way. You have to present in a schedule form, a statement. Schedule of changes in components of working capital. Okay. Let's see. C. Current assets, current liabilities. The difference between these two is the working capital. Compare the working capital of the previous year and current year. Previous year 100, current year 150. What does it mean? Your requirement increases by 50. That is called increase in working capital. So you have to write all the current assets independently. Preparing this way is very logical and easy, but we need to analyze further. Analyzing further in a statement form is going to be prepared here as schedule of changes in components of working capital. What are the components of working capital are there? Stock, debtors, bank balance, cash, creditors, and bank bills payable and bank overdraft all. Now, overall working capital increase or decrease, okay, it's very simple, but I need to know due to which component working capital is increased. So in that case, current assets may have a number of items like what? We may have stock, debtors, and all. Cash. Stock in the previous year 100, in this year 150. You have to find out changes in working capital independently for the current assets first of all. In that stock from 100 to 150 means 50 rupees increase. In case of debtors, 50 and 45. 50 rupees debtors becomes 45 means there's a decrease in working capital requirement. Put that. For each and every component due to that, is there any increase or decrease in working capital to to be found out and posted in the last two columns. Is that okay? That's how you can prepare the schedule of changes in components of working capital. I may try to solve this illustration. I have given the chapter cash flow and fund flow in single chapter. Like, okay, almost 7 or 8 questions are for cash flow statement. Among the 7 or 8 sums, selectively 4 sums I think is for the fund flow statement. Those 4 sums are solved for fund flow statement as well as cash flow statement parallelly. So once we complete, the same chapter is going to be recalculated for the cash flow statement, but there all the illustrations are solved. For the cash flow statement, we are choosing only 4 or 5 illustrations. We'll start with the question number 2. Question number 2. See, before that, you need to understand the working notes also related to preparation of fixed assets account. Fixed assets account along with the provisions for depreciation, and you need to understand how to prepare in case of non-current liabilities and share capital account, debtors and BR account, and creditors and bills payable account also. You need to have these basic ideas about preparation of the final accounts. Let's now start with the question number 3. This question number 3 will start with for preparing fund flow statement. Okay. So we have been given the balance sheet and all the details of balance sheet is given in notes to accounts. Additional information. Prepare fund flow statement for this illustration. In case of fund flow statement, you have to prepare the fund flow statement as well as schedule of changes in working capital as well as P&L adjustment statement. Appropriate means P&L adjusted P&L account to find out what funds from operation or cash from operation. Apart from that, you need to prepare the working notes for to find out some missing data. Is that okay? Let's see. Come on, join with me. What are the predominant 3 statements are going to be prepared here? Fund flow statement, adjusted profit and loss account to find out the cash from operations or fund from operations, adjusted profit and loss account, and schedule of changes in working capital for based on every component, previous year details and current year details for current assets as well as for current liabilities. Apart from that, you have to find out what could be the change in working capital requirement due to each and every component, whether due to the stock is the working capital is increasing or decreasing. So you have to calculate all these things separately. Is that okay? Hope now you'll be able to understand. Now, I'll just start with what? Let me finish up current assets and current liabilities. Right. In current liabilities, we have these items. Similarly, in current assets, we have these items. Okay. Let me finish up current assets first. We have inventories, stock. How much is that? 300 in the previous year, 280 in the current year. Due to the current stock, our requirement for the working capital is decreasing from 300 to 200, so 20 rupees decreased. Trade receivables or account receivables. Earlier 400, this year it is to 420. There is increase in account receivable by 20 rupees. Apart from that, cash and cash equivalents, but there is a schedule. As per schedule number 4, cash and cash equivalents are of two components. Let me finish up that one also. So, cash 201.65. So, here there is a decrease in cash balance 35 and bank 304.10. 110 increase happened. This one is over. Let's go for the current liabilities. In current liabilities, we have the trade payables. Trade payables given in schedule number 2. Let me finish up that one also. Schedule number 2, trade payables. Here, we have been given trade creditors. This value being 450, 250. Come on. Trade creditors decreases from 450 to 250 means is it actually increasing or decreasing our working capital? 450 becomes 250 means your working capital requirement increases. How? You have to pay it off. When the current asset is increasing, you have to contribute further. If the current asset decreases, then you are getting the cash out. Similarly, in case of current liabilities, if it is increasing, means you are making the payment delayed or you will have the cash in your hand. If the value is decreasing, you settle. So, money is, working capital is required higher. Otherwise, in this case, if it is increased, then add. In this case, if it is increased, means less. Put the value in the other way. Bills payable. Bills payable being 50 and 150. Increase means you have to put the value in the decreasing column 100. Apart from that, we have been given current liabilities, proposed dividend and provision for taxation. These two can be treated as sometimes current liabilities or it may be treated totally different way. Totally different way means you have to open the concerned ledger account. I will explain that later on here. Proposed dividend. This is one of the important point. The treatment will be the same for these two. Means proposed dividend as well as provision for taxation, the treatment will be the same. Proposed dividend and provision for taxation. Provision for taxation. The opening value being 100 and closing 125. Opening balance. Opening balance 100. Closing balance 125. Similarly, in case of provision for taxation, opening balance 50, closing balance 60. I will explain that at the last if there is no any adjustment. Okay, keep it pending. So we now try to find out what is the funds requirement due to the working capital. Due to the working capital means simply find out the working capital for the previous year and current year compared to the previous year. This year, if the working capital requirement is increasing, it may be assumed that you are in need of higher working capital, means higher fund. Let's see, we try to finish up tallying this. What is the total of current assets in the previous year? 1400, 1275. What about the total of liabilities? 500 and 400. Now what about the working capital? 1400 minus 500, 900 in the previous year. 1275 minus 400, 875. Compared to the previous year, 900 becomes 875, means your working capital requirement is decreased to 25 rupees, decreasing value being 25 rupees. I think there's a slight error. Current assets being 1200. Okay. You total this again. This is 1200. Yeah. 1200, 500. So balance being 700. 700 becomes 875, means you are in need of 175 excess. So additional working capital means what? Okay, trade credit increases by 200. Okay. So 175 additionally required. So you post that value here. Increase in working capital source or application. If we are supposed to introduce more fund for working capital requirement, then it is only applications of your fund. So it is going to be posted in the application side 175. Similarly, you tally the last two columns. If you tally this, increased value being 330, decreased value being 155. Compared to these two, there is increase in working capital by 175, right? Increase is higher. You can tally this as a ledger account, then you'll get 175. As I don't have the space, I stop here itself. Clear? Now, so we have completed the current liabilities as well as current assets. Before you go for the other things, okay, here what we have, shareholders funds. Three items we have: shareholders funds and reserves and surplus. Let me try to finish up the non-current liabilities as well as shareholders funds first of all. Reserves and surplus are given in the schedule number 1, so I'll pick that schedule number 1 here. That schedule number 1 consisted of 3 different reserves: general reserve, capital reserve, and profit and loss. Now, for the simplified approach, you can prepare all the ledgers, leaving the one share capital. What happens here? Share capital. It is not required to open all the ledgers account, assets and liabilities, non-current liabilities, and all. You need to open all the things. Only if there is any adjustments, it's better or safer to open the concerned assets or liabilities account. But for the better understanding, in the very first illustration, I will open all the ledgers so that you'll be able to understand a logical, systematic manner here. Now, share capital, opening 1000, closing 1250. So opening balance being 1000, closing balance being 1250. What does it mean? 250 increase. You may issue further. So further issue gives a rise for your cash balance or fund balance. Increase in fund. Non-current liabilities. Let's go for the non-current liabilities. Debentures. In case of debentures, reserves and surplus, this is schedule number 1, so I'll put it later on. Opening balance here, opening balance here being 500 and closing balance here being 400. Opening balance and closing balance. Is that clear? And schedule number 1, now I'm going to post. In schedule number 1, we have the capital reserve. We can better open that account here. Capital reserve, CR account. In CR account, opening balance dash and closing balance being 10. Similarly, we have been given the general reserve also, GR. In the opening, we have 250. In the closing, we have 300. Profit and loss, that is nothing but amount to be posted in the P&L account, adjusted P&L account. Opening profit in this case being 150. Opening balance. Closing balance here being 180. Either you can post this way, or the difference between 180 and 150, 30 rupees is the net profit. You can directly post at 150, the last line. That may also be correct one. This adjusted P&L account is one of the interesting way to get the fund from operations very easily. Okay, you don't need to have the thought process to work whether it is a cash related or operating related or not. You can very easily get this out. So we'll try to solve this using this model, adjusted P&L account model. So I have completed these things and this one also, current assets. So we now try to finish up posting the non-current assets. In case of non-current assets, we have been given property, plant, equipment. That is given in schedule number 3. So I will finish off along with the schedule number 3. Let me finish off long-term investments. Long-term investment. As it is asset, the opening should be in the debit side. Opening balance 100. Closing balance should be in the credit side. 50. Okay. Then property, plant, equipment, we have to go for. Property, plant, equipment given in schedule number 3. It comprises 3 assets. It is better to open all the 3 assets account. 3 assets account. Okay. Yeah. Land, building, and machinery. Land, building, and machinery. Now, in land, opening balance should be in the debit side. 100. Closing balance also in the credit side. Value being the same 100. Building opening balance 400. Closing balance 380. Machinery opening balance 750. Closing balance 920. Hope now you'll be able to understand this. Clear? I just posted all these things. You have to adjust the incorporate the adjustments and then try to finish up the illustration. You can get the answer easily. See? Now, what are the adjustments we have? Let me start with the first one, dividend. Dividend 100 was paid during the year ended. Now, proposed dividend, initially we have how much? 100. We have proposed to pay this one and now we paid. Bank, proposed dividend to bank 100. Then how the closing balance 125 comes here? Because of creating the proposed dividend for the current year. Proposed dividend is nothing but the dividend payable for the previous year profit to be payable in this year. For this year's profit, we need to pay the dividend later on. So this year we propose by debiting to the P&L appropriation account. So this will be in P&L account. See, this is one of the interesting model. When there is a bank, automatically it's a fund flow statement. It will be transferred to the fund flow statement. When there is a P&L account, it will be transferred to the adjusted P&L account. 100 means because of the proposed dividend, you have paid application. So I put the value here, proposed dividend paid. Proposed dividend paid. 100. And we have charged 125 in the P&L account related to non-operating. It is not operating, it's only appropriations. Appropriations is the amount shared to the various contributors from the net profit. To the owner, it's a dividend. For the government, it is interest for the future requirement general. So all these things are appropriations. Appropriation debited in the P&L account should be removed to find the funds from operation. So I'm transferring that here directly 125. Okay, you just forget about this. You can write this way also. Net profit for the current year being 30. With that 30, automatically this 125 amount transferred to the proposed dividend is added because it's a non-trade expenses, non-operating expenses. Now this one is over. 225, 225. Adjustment number 1 is over. Let's now move on to the adjustment number 2 and 3. 2 and 3. Adjustment number 2 and 3. Yes. Machinery during the year purchased 125. Machinery was purchased for a consideration of 100 payable in equity shares. Check the machinery. Initially we have 750 and at the end 920 probably after the depreciation. But 125 rupees worth the machinery purchased by paying cash bank. Another 100 rupees worth the machinery purchased by paying equity share capital. Whenever I use the term bank, it's affecting the funds from operations. You can fund flow statement, then directly transfer to the fund flow statement. If it is appearing in the debit side, it will be posted in the credit side. Here, machinery purchased. The value being 125. What about that 100, sir? I purchased by issuing the shares. So it affects the shares as well as machinery. Both are non-fund, so it's not flow. It will not be shown in the fund flow statement. Here, machinery purchased. Machinery purchased and for the consideration we have issued shares. The value being 100. 2 and 3 both are over. 2 and 3 both are over. Clear? 2 and 3 both are over. Now we'll go for the fourth one. Income tax provided during the year 55. Income tax provided during the year. What does it mean? We thought we need to pay tax rupees 50 and created this provision. While paying the actual tax, we came to know it's not 50, it's 55. So the payment in this case being 55. Tax account debit to bank. If the term bank is used, it's affecting fund flow statement. It will be transferred to the funds flow statement. And it is also application. You have paid this on provision for taxation. Application of fund rupees 55. On tallying this 115, you get the 55 rupees. Isn't it? 65, right? 65 being the balance. This balance is nothing but amount debited in the P&L account this year. So provision for taxation. How the provision could be 60 by the year end after payment of 55? You could have created the provisions in this year for the current year 60 and the shortage of 5 earlier. So in total 65 created by debiting to the P&L account. Clear? Now, company sold some investment at a profit which was credited to the capital reserve. Fifth one is one of the interesting adjustments. Company sold some investment at a profit, which was credited to the capital reserve. See, in your capital reserve, 10 rupees what you get here being the balance is due to the amount of profit. So, it will be due to profit on sale of, what's that? Investment. Profit on sale of investment. Should be transferable to the investment account here, capital reserve. What is that? In bracket, it is profit on sale. Profit on sale. Initially, opening balance 100, closing balance 50. What does it mean? 50 rupees worth the investment is decreased, means it might have been sold. 50 rupees investment sold for what rate? As the statement is clearly given in adjustments that because of selling the investment, we made a profit of 10 rupees. How do we get the profit 10 rupees? The profit is transferred to the capital reserve account. On verification of the capital reserve, initially we don't have the, any balance in capital, so finally we get 10 rupees. The 10 rupees could be due to the profit on sale. So 50 rupees worth the investment sold for 60 bank. This is how we get the missing data. Like whenever I get bank in these ledgers, it is related to what? Funds from or funds applied. Okay, source. So as it is being the sale of investment is nothing but source. The value being 60. The value being 60. And there was no sale of machinery during the year. There was no sale of machinery. If I tally this, what happens? 975. 975. 975 becomes 920 in the year end and assumed that there is no sale. Then why the value of the machinery is decreasing? 55 due to the depreciation. Depreciation usually will be debited to P&L account in bracket depreciation. Then it can be transferable to the adjusted P&L account, here depreciation. How much is that? 55 rupees. Depreciation of machinery. Clear? Then building costing 150, WDV 70. Original value 150, WDV being 70. The difference between these two 80 is nothing but what? Depreciation. Accumulated depreciation. Sold for 60. And 70 rupees worth the building sold for 60 means 10 rupees should be what? Profit on sale. Sorry, loss on sale. You get the value less than its WDV value. WDV value. 150, today's WDV value is 70. So, sold for 60 means we lose 10 rupees. And also it includes purchases. I have to incorporate all these things now. 7 and 8 both are going to be included. And we have the depreciation for the building also. I am going to record all these details. 7 and 8 for building related. Right. Building costing 150, but currently it's valued at 70, sold for 60. Bank 60. Then sale of building here. Source of fund 60. Original value 70, sold for 60 means 10 rupees lost. Loss reduces the value of the building. So loss on sale. Loss on sale 10 rupees will be transferable to where? P&L account. Loss on sale of building. Value being 10. And depreciation written off on this. How much? 20. Depreciation will be transferable to the P&L account here. 20 rupees. Hope you will be now able to understand all these cases. And the building has some purchases also. Come on, tally this. 380, 400, 470. 470. 400 becomes 470. That balancing figure 70 could be bank purchases. Okay. So, purchases of building is application of money rupees 70. So I have posted the sale value, loss and depreciation and all to the concerned places. Now, we have completed the proposed dividend account, provision for taxation. In case of share capital, 1,250, we get balance 150. What does it mean? 1,000 rupees worth of share capital becomes 1,050. It means we have issued 250 rupees worth of shares. Out of that, 100 rupees due to what? 100 rupees due to issuing this as a consideration for purchasing the machinery. So it will not have the fund flow. Balance 150 issued for the currency bank. And this will go to the fund flow statement, that to source. Issue of shares. How much is that? 150. Debenture initially 500, closing 100, so 100 rupees decreases. How? We might have repaid redemption of debentures. Redemption of debenture. So, redemption of debenture 100 rupees. And capital reserve got tallied. What about the GR? Initially we have 250, now it is 300. 50 rupees could be what? Transfer from the P&L account. This year appropriation from the P&L account. So transfer to GR. Transfer to GR. The value being 50. And long-term investment got tallied. Land no change got tallied. And building no change got tallied. Machinery also got tallied. Now come on. Last one to be tallied here is the adjusted P&L account. Get me the total and find out the balance. Get the total and find the balance. Hmm? 345 or 55? Three? Okay, 355. One small adjustment. Income tax provided during the year is 55. I made a mistake. I thought it's paid. It is not paid, it's provided. Provided means the amount debited to the P&L account. This one is 55. I stand corrected. Clear? Then this will be 105. 105. The amount debited to the P&L account is 55. The payment is found out as a missing data. How much is that? 40. 40 should be here. 45. Okay. 45 is the payment. Okay. I just posted the other way. It is a provided, not paid. Provided, not paid. Yeah. Come on. Now find out the total. I think it is 345. The entire balance is nothing but funds from operation. Funds from operation is nothing but sources of fund. So funds from operation 345. Finally, tally the funds flow statement. It will get tally. I think so. It's agreeing at rupees 615. Is that clear? Now you can write this as a statement. If you want to write this as a statement, you start with the net profit, add non-cash items, add non-operating items. That's how you can do additions. How do you add? Net profit, add non-cash expenses, GR transfer, depreciation and all, minus non-operating expenses. What are they? Dividend and tax proposed and loss on sale. That's how also you can calculate and get the answer. Rather than putting the value being 30 as net profit, you can write 180 and 150. So if you are writing the total value 150 and 180, the ultimate funds from operation is the same, but the total is different. Is that clear? Hope now you'll be able to understand the simple concept of fund flow statement here. Let me give the summary. In fund flow statement, what do you have to do? Prepare funds flow statement, and better you can prepare one more statement called funds from operation calculation, and finally schedule of changes in working capital. Changes in working capital. So in case of working capital, current assets minus current liabilities compared to the previous year. Okay, previous year and current year, for every item, what could be the change? Okay, find out the working capital, which is nothing but the difference between current assets and current liabilities, and find out finally whether it is increasing or decreasing. Apart from that, for each and every component, there is a change, right? That change is increasing the working capital requirement or decreasing in working capital requirement will be calculated in a separate columns, and by tallying this, you can get the answers comfortably. Is that clear? In case of funds from operation, you will start with the net profit, add non-cash expenses and non-operating expenses. Okay, and what to be subtracted? Subtract non-cash income and non-operating income. You can subtract these two. Add these two, subtract these two, then ultimate value what you get is nothing but funds from operation or funds lost in operation. You can get this easily by preparing adjusted P&L account this way. Net profit, automatically all the addable items are shown here, all the subtracting item will be shown here. Ultimately, you will get the funds from operation, that way also can show. And in funds from operation, here sources and here application. What are the sources? Decrease of the non-current assets and increase of the equity and shareholders funds and non-current liabilities. Similarly, increase in non-current asset is an application. Decrease in equity and non-current liabilities will be the application. And decrease in working capital is source and increase in working capital application. Similarly, funds from operation is source, funds lost in operation is application. Apart from that, you need to understand we might have paid the dividend as well as tax. These two will be now also involving the applications of your fund. These are the set of statements you have to understand. To find out some missing data, it is better to prepare those concerned assets and liabilities account also. So I explained already here. Here. Funds flow statement. Okay, here I have given all these things. Fund flow statement model and how should be the statement, how should be the adjusted profit and loss, how should be the changes in working capital all. And apart from that, of course, you need to better understand to open the concerned assets and liabilities also. Anyhow, these are the preliminary study you might have done at your group 1 as well as foundation, preparing the fixed assets and liabilities as well as debtors and BR, creditors and bills payable, provision for taxation, proposed dividend and all. Using this, we can solve this illustration easily. Hope now you'll be able to understand the third question. Third question, otherwise the first question for the fund flow statement. Yes, join with me. Question number 4. You have to open all the requisite ledgers. You can join with me to open all the ledgers. So, we prepare fund flow statement, sources, applications, adjusted profit and loss for calculation of funds from operations, and changes in working capital. Schedule for that. Previous year details and current year details. Increase of the current assets and current liabilities compared to the previous year and decrease here. Okay. Yes. Now we'll start with what? First we'll finish up the current assets and current liabilities. These are the current assets we have. And trade receivables and cash equivalents are given in two schedules, 4 and 5. Yes. Come on. In current asset, what are the items we have? Inventory, stock, 300 and 280, 20 rupees decrease. Trade receivables are account receivables. In that we have two classifications. Fourth, trade receivables and provision for doubtful debts. If the provision for doubtful debts is subtracted from the trade receivable, you can take the net of the value 400 and 220. Along with the provisions, we can still calculate the other way, but for simplified calculations, you can skip this one. So 420 and 120, sorry, 400 and 120. Then 180 decreases. And cash equivalents, there we have the cash and bank balances. Cash being 200 and 165. Decrease of cash requirement by 35 rupees. Bank 300 and 110. Here 190 decreases. Then overall current assets requirement in this case being 1200 and 775. How you are making the same mistake again? Current liabilities. So I have posted the current assets first. Let me try to incorporate the current liabilities here. We have these three: trade payables and other current liabilities. Trade payables given in schedule number 2. I'll pick that one here. Schedule number 2. So here we have been given trade creditors, value being 300 and 250. Decrease in current liabilities is nothing but increase in current liabilities, means working capital requirement. Similarly, in case of bills payable, 50 becomes 150. Increase will be shown in the decrease sign. And rest of the two other current liabilities, proposed dividend and provision for taxation, is better to open that concern account. Proposed dividend. Even you can consider this being current liabilities and treat this as a part of current liabilities and show in the working capital schedule itself. But if there is any adjustments for this proposed dividend as well as provision for taxation, it's better to open separate ledger account. Better to open the separate ledger account. Proposed dividend and provision for taxation. I am not aware about whether there is adjustment or not, but currently I assume there may be chances of adjustment, so I am posting that in a separate ledger. Opening balance here, proposed dividend 100, closing 125. Provision tax for taxation, opening balance 50, closing balance 60. This sum also similar to the earlier sum, but I made slight changes here or there to make the illustration totally different form to cover all the adjustments forms. So you can join with me to solve this easily. So I have completed the current assets and current liabilities posting. Now let me go for the shares and debentures. Shares and debentures. Share capital, equity share capital. Opening balance should be in the credit side, being 600. Closing balance should be in the debit side, 1250. Reserves and surplus, I have to go and refer the schedule number 1. And non-current liabilities we have been given here, so I'll finish up that first of all. Non-current liabilities. Non-current liabilities is nothing but debenture here. Opening balance being 500. Closing balance being 400. Now, schedule number 1, reserves and surplus. In reserves and surplus, this one, these two, GR and P&L account. So here P&L account being opening balance 700 and closing balance 190. Isn't it? 700 and 190. Closing balance 190. Naturally, there's a loss. So I've just made a slight change here, net loss. Last illustration, we have the profit. GR, initially we have 250, currently now we have 300. Do you want to open the account? Not required. You can directly post the transfer value here in adjusted P&L account, so transfer to GR. Rather than opening this account, you can just transfer the balance, which difference in wherever can be posted. You can directly post in adjusted P&L account. But if there is any adjustments, of course, you need to open the ledger account to post it clearly after finding the reasons. Okay. Now, so with that, liabilities are over. Now, non-current assets, property, plant, equipment, as well as non-current investments. Here I have to consider schedule number 3 also. Schedule number 3. See, schedule number 3 is all about property, plant, equipment, and non-current investments being 550. So non-current investment. In the year beginning, we have 100. In the year end, we have 50. And in case of property, plant, equipment, schedule number 3 to be referred. The schedule number 3 is given here. We have 3 assets here. The uniqueness of this problem is building and machinery we have been given original value along with the accumulated provision for depreciation. If the accumulated depreciation model is given, you have to open the asset along with the provision for depreciation also parallelly. If you have any confusions of opening this particular ledger, go and refer the foundation related topic, especially this one, depreciation, provision for depreciation model. You will be able to understand this. Anyhow, I'll just give the base idea here. You don't need to worry about that. Land. In case of land, actually land being non-depreciable assets, initially 100, year end 600. What does it mean? 500 rupees worth the asset may be purchased. It's an application. You can directly post in the fund flow statement, no problem. For the safer side, we can post that in the adjustments, whether is there any adjustments for the land or not, I'm not aware about that. So rather than posting directly in the fund flow statement, I can post that in the land account, in land, opening balance 100 and closing balance 600. In case of building along with its accumulated depreciation, original value model is going to be followed here. So provision for depreciation on building. Similarly, machinery, apart from that, provision for depreciation related to machinery. So in case of building, opening 650, gross value will be taken. Opening value, gross value should be taken. The gross value here being 650 and closing value being 570, not depreciated value, original value. The accumulated depreciation on this is transferred to or available in the provision for depreciation in the reverse side. Opening balance should be in the credit side, closing balance should be in the debit side. The accumulated depreciation for the building being 250 and 190. 250 and 190. Similarly, in case of machinery, the opening balance under original value model should be in the debit side. Closing balance should be in the credit side here. Machinery. So initially 1000 and 1220 and provision for depreciation, opening balance and closing balance. Opening balance should be 250, closing balance should be 300. 300. Hope now you'll be able to understand this one. This is the case. Now I'm going to incorporate the adjustments. I have posted all the items given in the balance sheet. Now I'm going to incorporate the adjustments. Okay. Company sold some investment at a loss of ₹100. Investment sold at a loss. Earlier illustration it's a gain, now it's a loss. ₹100 becomes 50. Means 50 rupees worth the investment sold. At a loss means we get only 40 rupees collection. So here bank account 40, 10 rupees being loss on sale. Bank account is sources. So sale of investment, the value being 40. Loss on sale. Okay, related to non-operating expenses should be posted in the debit side of the P&L account. There was no sale of machinery during the year. Machinery, what about the sale? Nil. We don't have the sale. I just marked down. Not required, but I marked down. So while solving that, I should not get confused. 1000 becomes 1220 definitely due to purchases only. Of course, there is no sale. 220 could be the purchases. You can guess easily. Anyhow, I can finish up telling this all at the last. So I have incorporated 2 adjustments. Let's move on to the third adjustment. Very, very important. Building costing 150, WDV being 70, was sold for 100 and purchase was also made. One of the interesting adjustment. Unless you are master with the provision for depreciation model at the fundamental level or foundation level of account, even in your same group 1 accountancy also you have. You have to open the assets account along with the accumulated depreciation. In that case, if any asset sold, you know, the depreciation on that assets up to the date of sale is now transferable from the provision for depreciation to asset account. Okay. Building account. This is nothing but depreciation. What is this? This is nothing but depreciation for the asset sold since the date of purchase of the asset to the date of sale. I may explain here in detail. original value being 150, today's WDV value being 70, and this was sold for 100. 70 rupees worth asset sold for 100 means you get 30 rupees excess called profit. 150 minus 70, 80 is nothing but accumulated depreciation, usually shown in the provision for depreciation. You have to incorporate all these things. This accumulated depreciation, should be posted twice. Adjustment item like. As provision for depreciation is an adjustment, it should be posted twice. One is in the provision for depreciation account, another one is transferred to the building account 80 rupees. And amount recovered on sale, bank account here, 100 rupees you recovered. Another place should be sources here, sale of building. Sale of building. Sale of investment, now sale of building. Another, due to this, we gained 30 rupees should be shown where it gives a rise to the building, so profit on sale. Profit on sale should be posted in the credit side of the adjusted P&L account. So here, profit on sale. Okay, sale of building. This value being 30 rupees. Cross verify that I have completed posting twice all the items incorporated from the adjustments. Is that okay? You have to be double cautious here. Clear? Hope now you'll be able to understand. So I have given that format also here. Anyhow, I just briefed the required thing. Probably I may guide you once again in detail along with the cash flow statement. So you can go and see the cash flow statement. This is what about the WDV model. Here, original cost along with the provision for depreciation model. How this account and how this account. Anyhow, I'll share the video for this particular video from the foundation level topic. You can go and refer this one so that you'll be mastered with this particular accounting format. Right. Now, so fourth adjustment, debentures are redeemed at a 10% premium. Debentures redeemed at 10% premium. Non-current liabilities debenture 500 becomes 400. 100 rupees redeemed, while repaying we paid 110 bank. Redemption of debenture is application. Redemption of debenture application 110. That excess payment of rupees 10 is your loss. Premium on redemption is your loss. Loss is debited to the P&L account. Okay, premium on redemption of debenture. This value being 10. This value being 10. Clear? Double entry, double entry. Always cross verify whether you calculated any value from the adjustments posted twice. If you are recording from the balance sheet, then it should be posted once. Okay. Either opening and closing will be posted in the both the sides, opening and closing like, or if you are taking the difference, it is also assumed both the items are posted. Both the items are posted. Proposed dividend and provision for taxation are considered as non-current liabilities. Non-current liabilities means you should not show that as a part of working capital. Okay. As already told you, sometimes this provision for depreciation, provision for proposed dividend, both can be shown here itself rather than opening the separate ledger account. But if it is clearly stated, it should be considered as a non-current, then you have to open separately. Right, I have opened this. Interim dividend 50 was paid, interim dividend. So, interim dividend payment is debited to P&L account, interim dividend 50. Not only that, it's an application, interim dividend. The value being 50. And I request whenever the information related to the provision for doubtful debts, you always skip this. You no need to worry about that at your level. Okay. Very rare scenario you may get the adjustments related to the doubtful debts. If it is possible, I will explain along with the cash flow statement here. Not. Now try to finish off all the ledgers. If nothing stated with the provision for proposed dividend and provision for taxation, opening is assumed to be the payment made in this current year. Closing is created in this year by debiting to the P&L account. The opening payment will be application. So, dividend paid, final dividend paid. This value being 100. and 125 proposed dividends should be posted in the debit side of the P&L account. 125. Similarly, provision for taxation opening is paid and closing is created by debiting to the P&L account. 50 and 60. 50 and 60. Okay. In application, tax paid. This value being 50 and 60 rupees P&L account. Provision for taxation created, debited to the P&L account being 60. Equity share capital initially 600, closing becomes 1,250. 650 could be issue fresh, bank account. Sources of fund, issue of equity share, 650. Issue of equity shares, 650. Non-current liabilities was already totaled and tallied, and non-current investment also tallied. In case of land, 500 rupees what? Purchases, applications of fund, purchase of land, the value being 500. In case of building, tally this 650, 750, and 70 is the balancing figure, could be what? New purchase of building, as there is purchases also involved in building costing, and it includes purchase, or it has a purchase also. We found out the purchase information as a missing data. Purchase of building is also application of fund. In application, I post that value 70. Provision for depreciation 270, balancing figure 20. Initially, we have 250. From there, depreciation for the asset sold 80 subtracted, yet we get the closing balance 190, means the additional 20 is nothing but the depreciation for all the assets in the current period. Opening accumulated depreciation plus current year depreciation is added to find out the closing. So this 20 will be nothing but current year depreciation is usually charged in the P&L account. So depreciation for building. How much is that? 20. Machinery, no sales, but the difference between these two could be purchases, bank. Okay, so here purchases of machinery, this value being 220. And in provision for depreciation, initially 250, closing 300, means the increase is nothing but the depreciation created for the current year for the machineries we have. So should be posted here, machinery, this value being 50. Rather than posting the opening balance and closing balance, you can write the difference here as 510 being net loss. 510 being net loss. You can show this way also. Now come on, finish up tallying the working capital requirement first. 350 and 400. Working capital in this case being how much? 850 and 375. 375 compared to the previous year 850. In this year, how much increase is there? 475. Decrease is there compared to the previous year. Earlier year we had 850, in this year 375. Decrease in working capital by 475. Decrease in working capital is sources of funds, so I will put that value here. Decrease in working capital being 475. And you tally this column also. If you tally this, I think 525 is decreasing, only 50 is increasing, means 475 is decreasing. 475 is decreasing. Decreasing working capital is nothing but again sources, releasing the fund. So in the source side, decrease in working capital. So that value was already posted. Okay, cross verify. Now, come on, find out the funds from operation by tallying the adjusted P&L account. If I tally this, I hope I get the value in another way. Okay, 540. Here, the balancing figure being negative, no, negative. So this value is called as funds lost in operation being 165. Funds lost in operation is nothing but application. I put that value in the application side. Finally, if I tally The funds flow statement agrees at 1265. 1265. So in this illustration, purposefully I made working capital being negative, means decrease in working capital. Funds from operation is converted into fund lost in operations. Apart from that, the assets account, rather than showing a WDV model, I have shown original value along with the provision for depreciation model, and clearly stated the proposed dividend as well as provision for taxation are considered as non-current assets and non-current liabilities. If you are considering these two being non-current liabilities, it should be posted separately. And debentures are redeemed at a premium, as well as non-current investments sold for a loss. All these things are incorporated, which is different from the earlier illustration. Almost all the concepts are over here. Two illustration, almost I covered all the concepts. If it is clear, text me. We'll move on to the next illustration. Question number 5. In question number 5, see here. Proposed dividend and provision for taxation were considered as current liabilities. So you can consider this being as a current liabilities only. Okay. And there is a hidden adjustment for interest on debentures and preference dividend also. Okay. So let's start with this illustration. One of the comprehensive illustrations, question number 5. Question number 5 is comprehensive illustration. Similarly, question number 6 also one of the interesting illustration asked in the exam. Most interesting illustration. We'll try to finish up these two by today. Now, come on, open the concern ledgers and formats here along with me. Come on, make it faster. So, fund flow statement, sources and applications, adjusted P&L account, and changes in working capital, current year, previous year, increase and decrease. Increase and decrease. Now, proposed dividend and provision for taxations are considered as current liabilities. Let me finish up current liabilities posting first of all. Current liabilities. And current assets. In current assets, we have two schedules, 5 and 6. 5 and 6. Trade receivables. Actually, 4 and 5. 4 and 5. Yeah. Yes. Try to post along with me faster. Current assets. Under that, we have stock. Initially 300, then 280. 20 rupees decreases. Trade receivables. Account receivables are debtors. If there is any provision for doubtful debts, you can take the net of that. Don't take the provisions and skip that and take the balance. 400 and 420. 20 rupees increases. Cash and bank, cash and bank, I can club these two. Usually better show it separately. 500 and 410. There is decrease in working capital requirement due to this being 90. 90. So we have completed posting the assets, current assets. In liabilities, current liabilities are two items here, trade creditors and bills payable. Thousand 110, I think. $575. 575. Okay. This is 575. Okay. This being 575. Now what is the final value? 1275. So cash and bank increases by 75. In Singer Academy's texts, I have treated the doubtful debts separately. If you want to understand that, you can try to understand from the text, but for my concern, it's not required. For my concern, it's not required. In case of current liabilities, trade creditors and bills payable. Trade creditors and bills payable. Creditors and bills payable. How much? 450 and 250. Decrease should be posted in the increase as well as bills payable. 50, 150. Increase, then it should be posted in the decrease side. Proposed dividend is considered as a part of current liabilities. Then it should be posted here itself. The sum seems to be pretty simple now. Increase will be posted in the decrease sign. And provision for taxation. Provision for taxation. 50 and 60. Increase should be posted in the decrease side. 10. Then overall value being 650. 650. Here 400. 585. Isn't it? Now find out the working capital here. 550 for the current year. Previous year. Make it faster. Oh, previous year and current year, I think. Right? Yeah. Previous year and current year. You have to calculate and let me know. Come on, make it faster. 690. And increase being 295. Decrease being 155. So decrease is lesser, then ultimately there is an increase by 140. Am I right? So increase in working capital being 140. Increase in working capital 140. Then application. Hope now you'll be able to understand this one. Clear? Apart from that, I'm going to post the other items here. Now, these two are having adjustments. So I'll start from here. The big list is there. Big list. Okay. So we have been given equity share capital, 12% preference share capital, general reserve, profit and loss can be posted later, securities premium, revaluation reserve for land, capital reserve Okay, so I'm going to post all this value. GR opening balance in the credit side 250, closing value 300. Profit and loss, I can post it last. Securities premium opening balance dash closing balance being 10. Revaluation reserve opening balance dash closing balance 100. Capital reserve opening balance dash closing balance 10. In the case of profit and loss, opening balance opening balance 150, closing balance 190. Otherwise, current year profit be 40. That way also you can post. Schedule number 1 and 2 were posted here. Sir, 1 is there, no? Okay. Schedule number 1, equity share capital and the preference shares. So opening cap balance 1000, closing balance 1250, and 12% preference share capital opening balance 400 and closing balance 500. So I have posted all these values here. Clear? Schedule 1 and 2 over, and now let's go for the 10% debenture opening 500 and closing 400. 10% debentures. Opening balance, closing balance. Opening balance being 500, closing balance being 400. With that, we have completed posting all the liabilities item and current assets also. And property, plant, equipment and non-current investment. Let me finish up non-current investments first of all. Property, plant, equipment, we have to take from fourth one. Non-current investment beginning 100, last 50. Okay. Now, non-current investment. Non-current investment. Opening balance 100, closing balance. Closing balance. I don't have the space. I'm writing very short form, like to keep all the ideas or workings in the single page. Apart from that, schedule number 4, property, plant, equipment. Property, plant, equipment. We have been given 3 assets here: land, building and machinery. I had to open these 3 ledgers also. So, land, building, machinery. Machinery. Opening balance being land 500, closing balance 600. Building similarly, opening balance 400, closing balance 500. Machinery opening balance 750, closing balance 920. So we have posted all the items given in the balance sheet. I am going to incorporate the adjustments one after one. Additional information now. 6 is over. Bad debt you can skip this. Bad debt you can skip this. And we'll start with 1, 2, 3. I tried to finish up first 3 adjustments here. Yeah. Debentures were redeemed at 10% premium at the year end. So debenture 500, year end 400, 100 redeemed. While redeeming, we paid 10% excess, then 110 back. That excess payment being the loss or premium on redemption. Premium on redemption is debited to the P&L account. Premium on redemption of debenture 10. And because of the redemption, there is an application. So redemption of debenture. Application of fund. Application of fund being 110. Adjustment number 1 is over. Adjustment number 2, preference shares were issued at 10% premium at the end of the year. Preference shares were issued at 10% premium. So 400, 500, 100 rupees worth preference share issued. That one issued at 110. So bank. That excess amount you know is nothing but premium on issue. Premium being 10 rupees. Securities premium. Securities premium account here is. So premium on preference share capital issue being 10. Collection. Issue of preference share capital. We got 110 rupees. Hope you will be now able to understand the link between creation of securities premium as well as the issue of preference shares with premium. Depreciation for building and machinery were 50 and 70 respectively. Here depreciation 50 and here depreciation 70. These two are non-cash items, so should be added with the profit, otherwise post in the debit side. So depreciation on building 50, for machinery 70. So completed posting 3 adjustments already. 3 adjustments already. Right. Then fourth one. Investment consisted of shares in other companies were purchased and dividends amounting rupees 10 declared out of the profits made prior to the purchase has received and used to write down the investment shares. Okay. Investment consists of shares in other companies. Okay. So we received 10 rupees. Pre-acquisition dividend. If the pre-acquisition dividend we receive should be subtracted from the concerned investment account. Concerned investment account. So from its sale, like you have to treat. Though it is a dividend, it should be considered as a sale and source of fund. The value being 10 rupees. The value being 10 rupees. Is that okay? Now, dividend from pre-acquisition dividend. Where is that investment? Here, dividend. 10 rupees. Pre-acquisition dividend. Sources. This is nothing but sources. Sale of investment, like dividend received out of pre-acquisition in profit. Right. You just remember this one. In case of dividend declared out of the pre-acquisition dividend, it should be subtracted from the investment account. And otherwise, it's a normal dividend credit to the P&L account. It's not normal dividend. It's a return of your investment. Okay. So understand pre and post. In case of pre, it should be subtracted from the investment's value. In case of post, what do? You post that in the P&L accounts credit side and source side. In case of pre, it should be posted in investment account to reduce its value and source side. You have to understand this one. Profit on sale of investment was credited in the capital. So there's a profit in investment sale that is given in the CR account. In CR account, we get 10 rupees. This is nothing but profit on sale. Profit on sale. So I transfer that 10 rupees here. Profit on sale. Transfer to the CR account. Here there is a balance. If I tally 110 and 60, there is a balance of rupees 50. What is that balance? Maybe sale of investment. Sale of investment. So I assume this is being the sale and sources of amount. So sale of investment. Sale of investment. Is that clear? So any investment you make, you get the interest or dividend. Always cross verify whether it is from the pre-acquisition profit or post-acquisition. In case of pre-acquisition, you have to subtract from the assets and post that in sources. If it is being the post, it should be posted the credit side of the P&L account, and next entry will be the sources side. Any of these concepts you can link with cash flow statement. There I can brief a lot. Okay. 1, 2, 3, 4, 5 also over. 6 over. Bad debt, I already told you to skip this one. Eighth one. Stock which was valued at 290 as on this date was written up to its cost 300 for preparing the profit and loss for the year 2021. Here, this one 290. Here it is 290. Thereafter, they have inflated this to 300. Already inflated values there. Don't do any more adjustments. Otherwise, for this illustration, you skip this one. So I have skipped these two adjustments for this illustration for the time being. One more information I am going to share here, hidden adjustments. Whenever any rate of interest as well as preference shares with dividend rate given, you have to find out those things as a hidden adjustment. Again, this hidden adjustments category can be explained later on along with the cash flow statement. Here I am going to skip this. So this hidden adjustment is skipped here. 7 not required at all, and 8 skipped here, and this one is not required in this illustration. Anyhow, how to handle the hidden adjustments I will explain detail along with the cash flow statement. Clear? Yes, come on. Finish up tallying all these things one after one. Equity share capital 250 rupees may be issue. Issue of equity shares. 250. Preference share got tallied. GR 50 rupees transferred from the P&L account. Here transferred to GR being 50 rupees. Securities premium got tallied. Revaluation reserve. This revaluation profit is due to the land's revaluation, so it should be posted in the land account. Land initially 500 rupees becomes 600, not because of purchase but because of revaluation profit. So this one also tallied. CR tallied. Non-current investment also tallied. Debenture tallied. And land also got tallied. Now what about the building? 550 and 150 could be new purchases. Bank account new purchases. Should be posted in the application. So building purchased. Building purchases being 150. And machinery 990. What's the value here? 240. This is nothing but bank. Here in application side 240. Purchase of machinery. And tally the adjusted P&L account to find out funds from operation here. 220, I think so. Am I right? 220 being the funds from operation is a source. Are you getting this? Don't refer the book answer. There are hidden answers also there. Opening balance, closing balance difference is 40. Am I right? Yeah. Yes, finish up tallying the funds from operation and get the answer. Tallying. Yeah. 640, it's agreeing now. Finish up tallying this. What is that hidden adjustment here? Let me finish up that part here. Anyhow, I'll explain in detail along with the fund flow statement. 12% preference dividend is there. No, we assume this company offered 12% preference dividend on this 400 rupees, means 48 rupees. If dividend paid, what happens? It is not actually operating expenses, it's an appropriation. So put that value here, preference dividend 48, and post that in the application side. Similarly, the same way interest 10% on the opening. You can calculate on the opening or closing, that's depending upon your assumption. On the opening 500 means you have to put 50 rupees being non-operating expenses because of financial expenses, and that same 50 will be posted here. As you put the 98 rupees here, 98 will be increasing, that will be automatically added here. By the time also you get the fund flow statement tallied. Hope you will be now able to understand. So this is how we can incorporate in case of hidden adjustments related to the preference share capital as well as debenture associated with the rate of dividend as well as rate of interest is given. Okay. Otherwise, least bother about that. Okay. Come on, make a note of it. This question number 6 is one of the famous illustration because of this adjustment. During the current year ended 31st March, dividend 19,500 was paid and the assets of another company were purchased. The assets of another company was purchased for 37,500 payable in fully paid up equity shares. For that, shares offered. The assets are being stock, machinery, and goodwill. Okay. Now, share is offered for goodwill, share is offered for machinery, share is offered for the stock. Here, this is non-fund and machinery, goodwill also being non-fund. Only stock being the fund. So, share capital to stock will be considered as fund flow statement. Rest of the two is not coming under fund flow statement. That you have to be careful. Rest only because of that reason. This question was asked in CMA final carrying around 16 marks. Very old illustration. Currently, it may be very simple illustration. Right. Apart from that, in addition, the other things also given. The sum is pretty simple. Let's now start with the same ledger accounts to be prepared here. Come on. I have covered around 4 illustrations, but it covers almost all the points. All the points. Now, fund flow statement and adjusted P&L account, changes, schedule of changes in working capital, current year and previous year, compared to the current year, okay, previous year and current year, okay, previous year and current year, compared to the previous year, is it increasing in the current year or decreasing? Okay, let's start with posting the things first of all. Finish of posting the current liabilities first, current assets first. So we have been given these current assets here. No schedules, you can directly post here. Current assets. Inventory. Inventories. The value being 80 to 500. 69,000. So naturally it decreases by 13,500. Accounts receivable 64,620. 52. 73. So decreases by 12,547. Cash and cash equivalents 1,125. 8,250. Increased by 7,125. Other current assets like prepayment 25, 27, 750, 17, 77 decreases. Total current assets being 1,50,000, 772. Here 1,30,000, 73. 1,30,000, 73. Now we'll go for the current liability side. We have been given three liabilities, current liabilities, and trade payables given in schedules. So I'll pick from the schedules here. So in current liabilities, trade payables, we have two items. One is creditors. Okay, I'll put directly creditors here. Creditors 29,250, 31,245. Bills payable 25,342, 8,250. Apart from that, bank overdraft also we have 45,000 in the beginning, end dash. Provision for taxation is better open a separate ledger, like considering this being non-current. If it is considered being non-current, it should be posted separately only. Clear? Provision for taxation. Provision for taxation. Opening balance 30,000. Closing balance 37,500. Here creditors compared to the previous year, this year increases, means you have to post that value in the decreasing side 1,995. BP decreases means should be posted in the increasing side 1,792. Here increase means decrease means should be posted in the increase side. Total of current liabilities being 99,592 and here 39,495. So working capital in this case being 51,180 in the previous year, 90,578 in the current year. So naturally, increase is there. How much increase is there? 39,398 increase. You can tally and guess whether it is increasing or decreasing. Increase side is 69,217. Decrease side is how much? Yeah, get me the value. Get me the value. Come on. 29,819. Definitely the difference between these two is nothing but increase in working capital. Increase in working capital should go where? Applications. Increase in working capital. We need 39,398 rupees further to be pumped into the business. So with that we have completed current assets, current liabilities posting. Then we'll go for non-current items. These three, only two items are there. That two, reserves and surplus only we have the schedule. Reserves and surplus we have the schedule. What's the schedule for reserves and surplus? We have two items here. Okay. If nothing stated, equity share capital, let me open that. Equity share capital, definitely there's a changes, lots of changes in equity share capital, so I will open that. Because equity share capital issued for purchasing a bunch of assets, initially 165,000, closing balance being 2,02,500. And profit, initially 29,768, year end 30,915. What is the net profit here? 1147. Am I right? 1147. What about the GR? If we assume that we don't have any adjustments, the difference is nothing but transfer to GR from the P&L account, the value being 7,500. You no need to open the ledger account. Unless there will be complicated adjustments, you no need to open, directly see the difference and post wherever it can be posted. That's all. So I have completed posting all these items here. So with that, what happens? I have completed all the liability sides and current assets. Now we have to finish up non-current assets. These are the items. Here, especially property, plant, equipment, schedule number 3 is there. As per schedule number 3, we have two items, property and machine. Yeah. Yes, post. Intangible assets, goodwill. Intangible assets, goodwill. And property, plant, equipment. Under property, plant, equipment, we have two items. One is property. Another one being machinery. I am posting the values here. Intangible assets, opening balance dash, closing balance being 7,500. Property similarly, oh sorry, it's an asset, no, should be in the debit side in the beginning. Okay, I just changed this. Opening balance should be in the debit side and closing balance should be in the credit side. Property also, opening balance should be in the debit side. 1 lakh, okay, 1,11,375. Closing value being 1,08,187. Machinery similarly, opening being 84,713. Closing balance being 94,650. Clear? So completed all these things. Now we have to incorporate the adjustments. During the current year ended, a dividend of 19,500 was paid. Dividend payment. Dividend payment should be posted where? Application side. Dividend paid. 19,500. Second entry, it should be debited in the P&L account. So I post that value in the debit side of the P&L account, 19,500. And a set of assets purchased, and for that the company issued the shares. Okay. See, I'm going to record this one. A bunch of assets purchased for 37,500. So equity share issued for stock 16,230. Machinery 13,770. Goodwill 7,500. 7,500. Is that okay? Now finish up telling all. 2,02,500 tallied. The increase of equity share capital due to purchasing these three assets. We purchased the other company. Other company's stock, machinery, goodwill came. For that we offered the shares. Double entry. Machinery will be posted in machinery account by way of equity share capital. We purchased the machinery. The value being 13,770. And goodwill also be purchased. So in goodwill, equity share capital paid for 7,500. See, machinery and goodwill both are non-current assets, non-fund, and equity share also non-fund. Non-fund increases, correspondingly another form of non-fund also increases. So there is no any flow. Fund to non-fund should be there, only then it will be considered as flow. Equity share capital and stock. Equity share capital is non-fund, stock is current asset, so it's a fund. So issuing equity shares for getting the stock is fund flow and will be shown in the fund flow statement here. So I may put the value here. Issue equity share capital. Equity share capital issue. Issue for what? Stock. This value being 16,230. Hope now you'll be able to understand this. So source of fund. What is fund? Equity share means fund is stock, debtors, cash, bank, and everything will be fund. If you are getting those fund by way of non-fund item, then it's a source. It is not only bank. Fund is not includes not only the cash. It includes all the current assets and current liabilities. If you are getting the current assets, then also be considered as sources of fund only. This is the only point most of the students got confused when they saw this question the very first time in their examination. Right. Rest will be very easy. Okay. In addition, a plant costing 4,237 was purchased during the year. Okay. A plant purchased 4,237. So here in plant, bank 4,237 application. So property purchase, plant purchase. The value being 4,237. Plant and machinery clubbed into single asset. Now, the following depreciation was written off during the year. Two depreciations are there. I'll put that value here. Depreciation. Depreciation on property as well as on machinery. Depreciation on property being 3188, machinery being 8070. So in property, you have to post that value here. Depreciation 3188, in machinery 3188 here. 3188. Here depreciation machinery case 8070. 8070. Double entry over. Then finally, this one. Income tax during the year amounting to rupees 21,578 was charged to the provision for taxation. So this year, the provision for taxation charged during the year amounting to rupees was charged to the provision. Right. Now, charge is nothing but payment made. 21,578 charged to this provision. So, tax paid. Tax paid. 21,578. And net profit for the year before taxation 57,225. Forget about that. Before tax means you can find out the net profit after tax and after appropriation. So if you are subtracting all these things, if you add up these three, what will be your value you're getting here? 19,500, 7,500. Okay. Clear? And you have to add the provision for depreciation charge in this current year. That will be calculated based on the missing data like here. How much is this? 59,078, 59,078, and P&L account provisions created in this year being 29,078. I'll put the provision here. Provision for taxation. Provision for taxation. Okay, I'll put the value here. I don't have the space here. So provision for taxation. 29,078. So you have to add the 3 and this provision also to get the book value, but of course not required. Whenever the net profit given in the adjustment, you skip that. But if you want to cross check, you can cross check and confirm that this value, how it could be arrived. Okay. Before tax means before tax and appropriation. Dividend should also be added. Transfer to the GP also have to be added, because all these things are after tax profit, whatever it may be, is used for sharing. So you have to find out you just to try to guess the answer. That's not required for your examination. So you have to add all the 3 and along with the provision for taxation. Now close the books of accounts. Provision for taxation over. Equity share capital over. Goodwill tally. Property. I think the property also getting tallied. 1,11,375. 1,11,375. What about the machinery? Hope machinery also getting tallied. 1,02,720. 1,02,720. Tally the adjusted P&L account. I think the value being 68,483. 483. 68,483. This 68,483, what do we get here? Funds from operation, also sources of funds from operation. 68,483. Tally the fund flow statement. 84,713. The sum is very, very simple. Such a way you can expect in your examination. Surprisingly for the CMA students, you cannot expect such a big question in your examination. I have seen 8-mark question asking you to prepare only schedule of changes in working capital, only this one. Very silly question, like only this one. There is no any comprehensive illustrations available for the CMA inter students. Anyhow, I have taught you all the comprehensive illustrations also. Go and see the past year's question paper, because I think financial management paper is for 60 marks or 80 marks. In 80 marks question, almost 20 marks objective type questions. Balance maybe only 10 marks or 16 marks question. 16 marks question itself rare. 8 marks question will be clubbed and formed as a 16 mark question. For this kind of illustration, at least 16 marks should be awarded. 16 marks questions are very rare. Only 8 marks and 10 marks, they asked only the fund flow statement of changes in working capital in your exam. Very silly question, like for 8 marks. Okay, go and refer the past year's question paper and find very simple illustrations for your exams to score good mark. Okay, that's all about fund flow statement. In the next class, we'll go with the cash flow statement. I always request you to